You've heard the old cliche 1,000 times. The trend is your friend. It's the first piece of advice every trader receives. But for most, that friend feels like they're ghosting you. You spot a trend, buy the breakout, and suddenly the market reverses, hitting your stop loss before continuing in your original direction without you. This usually happens when you buy the impulsive move. You see a massive green candle on GBP USD and buy right at the top, only to watch the market breathe and stop you out as it returns to a more sustainable price. Chasing a vertical line is an emotional reaction to a fear of missing out. This FOMO forces you to enter at the most expensive point possible, leaving your position vulnerable to even the smallest natural correction. Professional analysts avoid this by ignoring the adrenaline of a breakout. Instead, they wait for structural momentum shifts, using specific mathematical rules to separate institutional flow from retail noise. Capturing real profit requires a shift in perspective. You have to replace emotional reactions with a systematic framework that defines exactly where a trend begins and, more importantly, where it ends. To understand a trend, you have to look at market structure. In an uptrend, price moves in a series of higher highs, labeled here as HH, and higher lows, or HL. This stepping pattern is the result of a lopsided battle. Buyers are aggressive enough to push prices above previous peaks, while sellers lack the strength to push prices below the previous troughs. Your line in the sand is the recent higher low. As long as price stays above this, the trend is valid. If price dips but bounces without breaking that structural low, it's not a reversal, just a better entry price. Identifying this specific breaking point prevents you from panic selling. You stay in the trade as long as the structure holds, rather than exiting at the first sign of a red candle. While structure is your foundation, moving averages act as a visual filter. Specifically, the 50-period and 200-period exponential moving averages, or EMAs, help smooth out daily noise to reveal the average market sentiment. When the 50 EMA crosses above the 200, it's a golden cross, signaling a bullish shift. Buying when price is extended above these lines is risky. Professionals wait for a return to the 50 EMA before entering. To increase your accuracy, you need multi-time frame alignment. This means using a daily chart to determine the overall trend, and then zooming into a 1-hour chart to find your specific execution point. When the 1-hour chart dips into a value area, while the daily chart is still in a clear uptrend, you have confluence. This alignment filters out the majority of false signals and trap trades. The secret to professional trend trading is patience. You want to enter the market during the corrective move, the dip, rather than chasing the impulsive surge upward. To find the exact entry, we use Fibonacci retracement levels. These act as magnets for pullbacks. Specifically, the 50. A common strategy is setting a trailing stop at 2 or 3 times the ATR. Because the ATR represents the standard range of price movement, a 2x multiplier ensures your stop is far enough away to survive normal daily noise, while protecting your capital. This gives the trade room to breathe during minor pullbacks. As the price moves in your favor, you move the stop up behind it, locking in profit without choking the trend's ability to move higher. This removes the emotional urge to close a trade too early. You aren't guessing when to exit. You are letting the market's own volatility dictate the most logical point to protect your gains. Mastering Forex trends comes down to a 3-step process: mapping the market structure, filtering with moving averages, and executing with disciplined Fibonacci pullbacks. This approach isn't about predicting what will happen tomorrow. It's about reading the structure that exists today and managing your risk with precise math. Your next step is to look at your charts and find 3 pairs where the 50 EMA is above the 200. Wait for that pullback to the EMA, check for a candlestick reversal, and execute a trade with at least a 1-to-2 risk-to-reward ratio. Consistency comes from following the process, not from any single trade. Replacing emotional reactions with this structural framework transforms market speculation into a repeatable, data-driven business.